Well, Australia's private credit market is growing at breakneck speed. Zagga saying investor education failing though to keep pace, and that some investors are lacking adequate insight into the complexities of the asset class. Zagga Executive Director Tom Cranfield joins me in studio. Great to see you, Tom.
Thank you for having me back again, Juliet.
So, investor education not keeping pace here with the rapid growth.
Sure. I mean, I think from our perspective, you can see the trend lines are strong. As per the white paper that we recently released, we've now got a forecast that says that Australian private credit could be larger than the Australian bond market by 2029. We're seeing a reallocation in the fixed income markets of capital. We can see the shutdown in the hybrid market, and fixed income needs to have alternatives and various buckets to go into. So I think this is a relatively new concept for the investment market for private capital, self-managed super funds, wealth managers and the family offices. Whilst it's well understood, we're moving through cycles, and we're moving through cycles quickly. So in terms of education, we want to make what we see simple as we can for our investors. We don't want to introduce unnecessary complexity, but we think that transparency, communication, these are values that are fundamental to the integrity of good managers, and making sure that people who invest with you are fully aligned and aware of what the things that happen within a credit cycle are, and what we're investing in and what the nuances of that could be, is something that people want both from us and from the broader market as they continue to invest deeper into the private credit space.
What do you think are some of the biggest misconceptions about the asset class?
Yeah, look, something that I always try to focus upon is understanding that credit moves in cycles. So we can see cycles now. We've now gone through a COVID cycle, an inflation cycle, interest rate hiking cycles up and down. We don't want people to perceive it to be a cash or cash-like product. We want people to understand that they are investing in a risk product and they're getting a income generative return. Our goal is always to make that stable, to fundamentally do what we can to mitigate risk. We're not in the business of avoiding that risk. So as long as those sorts of concepts are well understood, and then at the moment the conversation probably gets more centered around liquidity. So is it a liquid product? Is it a semi-liquid product? Is it something that can give you T+3? Do they trade on exchanges? Is it traded at par? These concepts that we think about and talk about every day, they're not always the concepts that the investors who've moved to the asset class are talking about. So being seen to guide, to offer, we don't offer investment advice, we're a manager, so we're not here to do the education in the sense of their investment world. They need to do that with their investment managers. But understanding that we deliver the right information in detail so that they can know what type of liquidity, what things like gating looks like, what funds operate, open-ended versus closed-ended. These things are important for us, that our investors are well understood and that other investors in the segment understand it as well.
When you talk about liquidity there too, do you think that investors are fully aware of what they might be buying into?
Well, the US has been a very much a conversation point. I think people are talking about that now because you can see sort of the big six firms over there are now talking about gating or have gated. So I think people perhaps have been of the view that they could access liquidity faster than they otherwise can. We know when we invest and we set our investment strategy that these are important things. So for us right now, our duration risk on our portfolio sits at around 1 year. We invest in a 2 to 3 year cycle because we don't want to give people a non-liquid product. But where infrastructure or private equity might be 5-year lockups, 7-year lockups, progressive drawdowns, we're able to offer open-ended 90-day liquidity, 12-month lockups, and then we give people the full understanding of what that semi-liquid product looks like, what duration risk looks like, what the underlying inflation hedge is. And so you can see that there's a range of variables that need to be well understood, and that's why we believe if we can deliver white paper research and we can deliver that type of information to our investors, new investors, prospective investors, it helps everyone make informed decisions so that they can then get the type of manager they want, which is long track record, strong performance, and delivering the outcomes that they say they will, which is what we pride ourselves on.
We're seeing a lot of interest, I guess you could say, in Australian real estate private credit, particularly some global attention here.
Yep.
Why do you think that is happening when investors are being cautious elsewhere?
I think investors are being cautious in all segments of the markets at the moment. That's just from my observations on the ground, but I think private credit is an asset class that can generate income. I think for us, we invest in only new residential real estate. So in terms of the proposed legislation where negative gearing exists for people who want to be on the real estate hard asset side, there's a natural incentive drawing them towards that product. So for us, the fundamentals of migration, population growth, the tax advantages if the legislation passes that are available for new product, as well as our ability on the investment side, linking to that real estate to be able to generate stable income returns with an inflation hedge because we're variable. So as interest rate cycles are up and down, our performance has been consistent. I think that that's what's attracted the growth to the asset class. And then if you look at Australia in particular, and as I say, we purposely invest in residential real estate, multi-level residential real estate, new builds, more than anything else, that current market, including the secondary market, is valued at $12 trillion. So you're talking about the largest pool of assets in the country, you're talking about the deepest pool of assets. We're able to then selectively pick off metropolitan areas, deep markets, and where supply-demand imbalance is not met. So I think investment strategists, wealth managers, institutions, superannuation funds, they're able to see opportunity through the uncertainty. I think the opportunity exists because the fundamentals remain sound, the long-term drivers are there. And as I say, it's about being able to go through cycles, and we think in 10 years we've been able to do that. So if we can explain this and we can educate and we can release research papers that show this, hopefully that trend line of investment growth, continued investor growth, will be buoyant by our assistance in doing so.
So what do you think the next 10 years looks like, particularly when we've seen private credit kind of go from very niche to a bit more mainstream in the last decade?
According to Alvarez and Marcel's 2025 report, you're looking at private credit now representing 18% of the commercial real estate lending marketplace. The forecast is that growth goes to 30 to 35% over the next 10 years. If you look overseas, the US is somewhere near it at 50%, and the UK and Western Europe's around 35%. Given the growth in the sector with institutional money, wealth money, private capital money, our expectation is that it is sustained growth. We think that the market will be well understood, and we think the strong players who are well governed, who put in the effort to deliver these sorts of outcomes and do it on a repeat basis, will be well supported. And our view is in line with that Alvarez and Marcel forecast that it'll go to 18 to 30, 35%.